Joining me is Peter Schiff, Chief Economist at Euro Pacific Asset Management. Now, let me just get some reactions from you, Peter. Yesterday's speech, Powell says the U.S. banking system is sound and resilient. Well, what do you think?
Well, it's not sound at all. It is a house of cards that is starting to collapse. And the reason that the banking system is so unsound is really twofold. One, the Federal Reserve kept interest rates at zero for over a decade, basically. And during that time, banks loaded up on low yielding, long duration treasuries and mortgage-backed securities. They did this because they couldn't get any yield on short-term instruments, so they went out on the yield curve. But the reason they were able to take so much risk is because the government guarantees the bank accounts. And so the customers of the banks really didn't care what the banks did with their money because they were confident that if anything went wrong, the government would bail them out. That was the moral hazard that everybody learned from the 2008 financial crisis. And that's why this financial crisis, and everybody is reluctant to label it a financial crisis, but it is much worse than the one that we had in 2008, because thanks to the mistakes that the Fed has made since that crisis, we have a much bigger bubble now. The Fed caused the bubble that led to the financial crisis of 2008, and then they inflated a bigger bubble to try to paper over those mistakes and kick the can down the road so that we wouldn't have to deal with the full consequences of resolving all those mistakes. And of course, we just compounded the problem with bigger mistakes, and now the U.S. economy is poised on the biggest economic disaster in its history.
I don't hear many people calling this a financial crisis, and it's very interesting that you say that it is. Maybe expand a little bit on that.
Well, the 2008 financial crisis was about the banks. Why did we have a financial crisis? Because the banks held mortgages that went bad. And so many big banks were failing. You know, the big investment banks that went out were Lehman Brothers, Bear Stearns. But it was about debt that, was credit that was extended during a bubble where the borrowers couldn't repay as the air came out. Well, that's exactly what's happening now. It is a banking crisis, and banks are financials. I think people are reluctant to call it a financial crisis because they don't want to evoke the memories of 2008, and they don't want to, make any comparisons. They don't want to acknowledge that. But if you remember the events of 2008, because I remember it very clearly, because I was out there warning about the financial crisis and nobody believed me and people made fun of me. But early in that crisis, when the warning signs were clear for all to see, they were still dismissed. And even though I was pointing out the collapse was about to happen, everybody was diminishing it. Even when the subprime market blew up, that didn't raise any alarms. The Federal Reserve and everybody said, don't worry about subprime. It's all contained. So it's the same thing now. They are dismissing all the early signs of a major financial crisis. But make no mistake, we're on the cusp of one. And again, it's going to be much bigger than the last.
Right. You said it's going to be worse. What are we talking about here exactly?
Well, the banks that were too big to fail are much bigger now, and they're even more insolvent. The Fed never really stress tests what was going to happen. They just assumed that stagflation was impossible, so they didn't bother to test for it. But the economic event that the banks can't handle is a big decline in the economy coupled with a rise in inflation. So if we have high inflation and recession at the same time, the banks are going to fail. And the problem is the public is going to want to withdraw its money from these banks because the banks are not going to be able to pay an interest rate anywhere near enough to compensate for the continued erosion of the value of their deposits through inflation. And of course, when people want to get their money out of the banks, the money isn't there. It's been lost. It's tied up in underwater mortgages. And so the only way that people can get their money is if the Fed prints it. But when the Fed prints it, it just destroys even more of the value. And so it accelerates the momentum for a spiraling inflation.
In this whole thing, Treasury Secretary Janet Yellen is saying not a single taxpayer dollar is going into bailing out the banks. Let me get your thoughts. Who's bailing it out?
Well, it's anyone who holds US dollars. So that would include taxpayers in the United States and non-taxpayers, but it also includes people all around the world who have US dollars and own US dollar denominated debt instruments, because the dollar is being debased in order to fund the bank bailouts. The Fed's balance sheet last week exploded by $300 billion. That was $300 billion that didn't exist, that the Fed created out of thin air and provided to the banks. And that's inflation. And so when you do that, you destroy the value of all the money that's already in circulation. So Americans are going to pay, not because they're taxpayers, but because they're US dollar owners and US dollar earners. Everybody's paycheck is going to be reduced in value because of the bank bailouts. But also, these bailouts are endangering everybody's bank deposits, even the banks that are solvent, because now it's inflation that is the risk. And so it doesn't matter if your bank fails, you're still going to lose. In the event that your bank failed, you lose your money. But now, because the government won't let the banks fail, everybody who has a bank account is going to lose purchasing power.
Right, right. You mentioned the Fed's balance sheet increased by 300 billion. You're saying it's inflationary. That's pretty interesting because Powell yesterday said the Fed projects inflation will actually come down to 2.1% in about 2 years, 2025. What's your response to that?
Well, the Fed has gotten everything wrong when it comes to inflation. First they said there was no inflation. And then when it reared its head, they told us not to worry about it because it was transitory. And then they got that wrong and they said, oh, well, we're going to take action to bring it back down to 2%. Meanwhile, it's nowhere near 2%. It's at 6%. But the Fed just ended its tightening cycle and began a new easing cycle. So it's gone from inflation fighting to inflation creation, except now the new baseline is 6%, and we're going up from there. I think probably before the end of this year, we're going to be seeing annual inflation rates in the double digits.
Wow, double digits. You don't think the bank troubles will actually help inflation? Because maybe credit conditions could become tighter. Is that not going to help at all with inflation?
No, because the Federal Reserve is bailing out all the banks and it is flooding them with liquidity. It keeps printing new money. And so, they're not letting tighten credit contract. It should contract. But, if you look at the consumer, credit card debt is at record highs and rising. Savings rates are at record lows and falling. So people are spending everything they have and then some. The only way to bring down inflation would be to have people reduce their spending and increase their savings. But that's not happening. The opposite of that is happening. And of course, we need to have the government, the biggest spender of them all, needs to cut spending. These record budget deficits need to be brought under control. But none of that is happening. In fact, the government is spending more. The deficits are going up. So this is all an inflationary fiscal policy combined with a still inflationary and now super inflationary monetary policy with the return to quantitative easing. So no, inflation is going up. I mean, we're more likely to get to 20% than 2%.
Wow. And let me just point something else out. A lot of the lending growth in the U.S. economy comes from small and mid-sized banks. The majority of commercial industrial loans, commercial real estate loans, consumer lending, and residential real estate, these loans are coming from smaller banks. So that's very serious. And these are the banks that are having trouble with their deposits. Let me ask you, what do you think the next shoe is to drop?
Well, the government created that problem when they bailed out Silicon Valley Bank and Signature Bank and said the reason we're bailing out these banks and making all the depositors whole, even the depositors who had accounts that were not insured, is because these banks were so big that if we didn't bail out every customer, we thought it would have a negative impact on the economy. But what they're saying is if you happen to bank at a small bank and you have a large account and that bank fails, well, we're probably not going to bail you out because that bank is too small. And so your losses won't have a meaningful impact on the economy. So you're just going to be left to twist in the wind. And so when people hear this, the logical move to make is, if you are a customer of a small bank, to withdraw your money and put your money into one of these large banks that are too big to fail, or are systemically important, and therefore you know that your money is safe. And the irony here is the government, through this policy, is going to encourage uh, customers to withdraw their money from solvent banks and to deposit it in insolvent banks that are just more likely to get bailed out when they ultimately fail. And this is creating a run on the solvent banks, which will ultimately render them insolvent as well. So the government has taken a problem that it created and made it much worse.
Right, right. I want to talk a little bit about recession now. So the Fed projects unemployment will be around 4.5% at the end of this year. Probably more than 2 million jobs will be lost. Do you think the recession is happening this year because of that forecast?
Well, first of all, the Fed doesn't really forecast anything. They just make guesses, but they don't even really guess honestly. They always paint a rosy picture on the future. So you could basically, dismiss any forecasts made by the Fed as government propaganda. I think that what we're going to be going through economically is a depression, not a recession. I think it's already started. And, the reason that you can't see it in the government numbers is because the government numbers are rigged. They don't calculate inflation correctly. And so it looks like the economy is growing, but it's actually contracting. It's because we're overestimating growth because we're underestimating inflation. But I think this recession that nobody wants to admit we're in is going to get worse, and it's going to be here for the balance of this decade, which is why, I think it's a depression. But it's going to include very high inflation. So it's the worst of both possible worlds, where you have high inflation and then we'll have high unemployment at the same time. And corporate earnings are going to be falling, especially since their interest costs are going to be rising. Despite the Fed's efforts to artificially suppress rates, rates are going to rise anyway. So this is a real economic disaster, and I think it's going to be punctuated by a currency crisis, a U.S. sovereign debt crisis. I think the dollar is going to lose its status as the world's reserve currency, and that's it. I mean, that's going to pull the rug out from under this phony economy. It's going to come collapsing down, and Americans are going to be faced with a drastically reduced standard of living.
Wow, that's incredible. I mean, where do you put your money in this situation then? Maybe gold?
Well, you should have gold. You should have silver. I encourage people to have real money. Get out of this fiat currencies and cryptocurrencies, for that matter, that have no real value. You want to own real money like gold and silver. But, there are a lot of places around the world that you can invest that are going to benefit from these events as they play out. You have to realize that the world has borne a heavy burden sustaining the United States, keeping the dollar as the reserve currency. It requires the world to sacrifice significantly, in that other countries have to produce goods and then not consume them and then send them to the United States so that American citizens can enjoy the fruits of their labor. And then all they get in exchange for their hard work are pieces of paper that we create out of thin air. And then they take those pieces of paper and buy more pieces of paper so they can earn interest in the paper that we create out of thin air. And so the world is worse off. Everybody lives beneath their means to enable Americans to indulge themselves and live above their means. But when this insanity comes to an end and the dollar crashes, then Americans are going to see a decline in their standard of living. But the rest of the world, particularly emerging markets, your part of the world, Southeast Asia, over there, huge benefit, because now all these workers, let's say China, for example, they're working hard, they're producing a lot of stuff. Now they're going to consume the stuff that they produce. Instead of letting Americans have it, they're going to keep it for themselves, because their currency is going to go way up relative to the dollar. So now their wages have greater purchasing power, and so they can buy the stuff that they couldn't afford. Americans can no longer afford the stuff they used to buy. So our loss, China's gain, living standards go way up. In fact, I expect before the end of this decade, for the Chinese to surpass the United States as the largest economy in the world, just straight up GDP, and mainly due to the appreciation in the currency.
Interesting. You don't think the Chinese government, over time, history repeats itself over time. You don't think the Chinese government might do something similar or some kind of mistakes that America is currently making?
Well, look, all governments make mistakes. That's one thing they have in common. It's a question is which governments make the fewest mistakes. But look, at some point in the future, sure, China can be on the top for a while, and then it will fall. But I would imagine that China will be the dominant economy for the balance of this century. It's hard to say, what's going to happen, in hundreds of years into the future. But I think it's pretty clear that China and that region, Southeast Asia, maybe also Middle East. I mean, that part of the world, the East really, is going to dominate because these Western economies, by and large, not just the United States, but all over Europe, we're going to be suffering from high inflation. We've had big governments, large deficits, huge social welfare programs. All this is going to undermine the economic power of the West, and you're going to see that dominance move east.
Yeah, I mean, only time will tell. But thank you so much today for the conversation, Peter. It's always great having you on the show.
Oh, my pleasure. Take care.